the first step is starting with your lender. So meeting with a real estate professional that you trust. We can connect you to a lender if you don't already have one, but that's really the first step. And the lender, what they're going to do is pre-approve you. They're going to ask you for all kinds of documents to get pre-approved with. They want your bank statements. They want your tax returns. They want your driver's license, so they make sure they spell your name right, your social security number, all those kind of things. That's information that as a real estate professional, I do not need, nor do I want, but the lender needs all of that. With that pre-approval, that makes you a cash buyer. It makes your any offer that you put in very strong. If you're not pre-approved and start looking first, a seller is going to be leery to take an offer from you because they're not assured that you can purchase their property. So it's important that we start with the lender. Once we have that pre-approval letter, we are set to go. We can literally just that day, we can start looking at properties. So we're going to do a couple of things. You're going to be looking online. I'm sure you're going to look at Zillow or Trulia or one of those other apps that are out there. The Mahoney team, Keller Williams, also has their own app to look at. Once you have found a couple of properties that you would like to see, that's when we go ahead as your agent and get those showings approved. We try to do no more than 5 in a day because I think it gets very overwhelming, very confusing, and that's not what we want for you. We want you to be able to enjoy each one that you're seeing and kind of narrow it down. So if you're seeing 5, and you can cross off the ones that you didn't like so much and narrow it down to just like 2 or 3 that you really do like. And then we can go from there. Once we have the properties that we've toured and you enjoy them, you found one that you really, really want, that's when we make an offer. So it is a contract that we write up. It's the same one that we use throughout Florida. There's no differences from one agency to another or one realtor to another. As long as it's within Florida, we use the same one. And that, yep, I have to go back. There we go. That offer, once we present it to the seller, they're either going to accept it, reject it, or counter it. Most times they're going to counter your offer. And it's just the little nuances in the offer that they're going to counter, like how many days you're giving them till closing, whether you're asking for any concessions, whether you're asking for a home warranty, things like that. So those are the kinds of things that they would counter back on. Sometimes it's the price, but it's usually those little things that we ask for. Once your offer is accepted, the seller has signed all the paperwork and you've received the paperwork back, the seller has received the paperwork back, the lender has it, the title company has it, that is considered an executable contract. That is when you are finally under contract, and it is a legal binding document at that point. From that contract, there's a couple of things that is going to happen. The Mahoney team helps with giving you a list of home inspectors. You want to have that property inspected. We're also going to help you obtain homeowners insurance. You need to have that before you actually close. It's called binding the policy. And if we get a storm coming in the area, we want to definitely make sure we get that policy bound before the storm. Because once the storm is coming, those insurance companies shut down. So it's impossible to get insurance at that point for a while, just till they reopen again. So all those kinds of things. So getting your inspections, getting your homeowner's insurance, getting everything lined up. So for you as the buyer, it feels like, why is everything so quiet? Nobody's doing anything, but it's the opposite. Title companies working really hard, the lenders working really hard, trying to get everything lined up. And then everything gets all literally lined up for closing day. When I think of closing day, I think of it as a target. So we put a date and we're going for that date, but things happen. So that date really is on a sliding scale. Contract says that that's the date that the lender's going for, that's the date that the title company's going for. But again, things happen. Sometimes an appraisal comes in late. Sometimes there are repairs that have to be done due to the home inspection, things like that. So again, it has to be a little bit fluid. So I only point that out because I know sometimes as buyers, we want that, this is the date. And I'm like, that's what we're all striving for, is that date. You have an opportunity to either purchase a home warranty or to ask the seller to pay for one in negotiations, and sometimes that works. Home warranty, I kind of think of it as, it's not really insurance. Your homeowner's insurance is what's paying for, or what's taking care of the structure, the outside of the property and the main systems of the property. Your home warranty is going to take care of things like your appliances, or if there's a leaky toilet or something like that. So some of the smaller things. I can tell you as a homeowner, our refrigerator, our microwave, and I think it was our wash machine, all went before we finally bought a home warranty. And the home warranty would have taken care of all that had we purchased it ahead of time. So it really is a good thing to have. Before closing, you're going to do a final walkthrough. And the final walkthrough is just to confirm that the property is in the same as you saw it when we looked at it before we went under contract. It's also going to make sure that any repairs that the seller promised that they would do have been done, and that they have been done well. Seller is contractually has to do those repairs with a licensed contractor. So we just confirm all of that. And if everything's hunky-dunky, we go to the closing table. At the closing table, you're signing all the last documents that the lender needs. You're signing the last documents that the title company needs. And then you are given the keys to the home, and you get to celebrate moving in. So as a buyer's agent, I would be working for you, the buyer, or your agent that you have selected. And there's a lot of things that we are doing in the background that you're not always seeing. We're making sure that the lender is on schedule, and we're making sure the title company is on schedule. We kind of feel like we're a babysitter sometimes, making sure, but there are timelines that are in the contract, and we have to just make sure that everybody's adhering to it. We're also going to help you search for the property. We're going to help you find the right house. We're going to negotiate the contract for you based on your specifications that you have given us. And then we are going to get you to the closing table. Keller Williams has an app if you want to use that. And of course, there's Zillow and all of those as well. There's some pre-qualifying questions. This is especially for the lender. For me, I'm not going to ask you any financial questions. That is between you and your lender. Your lender is going to let me know what you can afford. Again, with the timing is your timeline. It's not my timeline. It's when you want to purchase a home. So if you tell me that you want to purchase a home by the end of, say, May, it takes 30 to 45 days for a lender to get you closed. So that means I have to have you, or you have to be under contract by the end of April to make that timeline. So to get to the end of May, we have to be under contract by the end of April. So that means we have from now until the end of April to find the right property, do the negotiations and all of that. Location, of course, is very important. You can't change locations once you buy a property. You can't lift it and move it. The property itself, you can change. So you're looking for something that meets most of your criteria. The chance that you find something that meets everything that you want in your price range, in the right location, all the check boxes, is slim. So what we try to do is find the ones that are most important to you. Because say you don't like the color of the walls. Well, that's an easy fix. It's like $32 for a bucket of paint, so it's things like that. And then you have to think about your lifestyle. Do you want to be closer to downtown because you like hanging out down at Palafox Market and do all the things that are downtown? Do you prefer quiet and you want land and have animals and be out that way? So those are the kinds of things that we need to talk about. And then communication is really important. You need to be honest with me as I'm going to be honest with you. When we're looking at properties, if you don't like it, tell me. If there's something you don't like, just tell me. You're not hurting my feelings. It's not my home. My home's not up for sale. This is one of the most important pages to show you. These are the 10 commandments when you're going for a loan. Do not do. Do not change jobs. Do not become self-employed or quit a job. Do not buy a new car or co-sign for somebody to buy a car. Don't miss any payments on the loans that you currently have. Don't reduce your account balances. If you've got a credit card with X amount on it and you're thinking, oh, it's going to help me to pay it off, please don't. Please go talk to your lender first and see how it's going to impact you. Believe it or not, when you close an account, it affects your credit score. Your credit score goes down, and it takes a while for it to reset to start going back up again. You don't want to buy big ticket items, so you don't want to buy a refrigerator, you don't want to buy furniture, you don't want to get all those things that you're thinking, oh, this will look good in my new house. Please wait till you have closed on your new house and then purchase those things. Then it's not going to affect you at all. Again, you don't want to open or close a bank account or a credit card, nor do you want to co-sign for a friend or family. And sometimes it seems small, like, oh, I was just helping them with their student loan, or I was just helping them with, you helping somebody without talking to your lender first can affect you being able to purchase a property. And we don't want that for you. So along with purchasing a home, there's some things that you need to know. There's money that is going to come out of pocket. Some of it is going to happen at the closing table, and some of it happens ahead of time. So earnest money deposit. These are the fees that are upfront, and I'll explain that as I go along. Earnest money deposit is your good faith deposit on the property. So say you're buying a $400,000 home, it's usually 1% of the purchase price, so it's $4,000. That $4,000 is going to be sent to the title company, and it's going to sit in the title company's escrow account until the day of closing, and then that $4,000 will be applied towards your closing costs. There is a home inspection, and I never recommend, even a brand new house, don't forego a home inspection. You don't know what's been missed. My husband and I bought a brand new home years ago. We thought, oh, they've had the county coming through, all those inspectors going through. We don't need to get a home inspection. We learned the hard way. That first spring, when the snow started melting, we had water pouring through our back windows. And it's because the builder forgot to put flashing around the chimney. So if that could happen to us, it could happen to anyone. I know it doesn't snow down here, but still there's something that could get missed. There's been times when insulation didn't get put in. There have been times when there have been bad shingles that have been put on a roof. There's all kinds of things that could happen. I had one new build where they sheetrocked over one of the plugs in the kitchen, and every time they tried to use their iron, it would kick it off, like the GFCI outlet kept on kicking it off. And it took forever for them to figure it out. Finally, somebody figured out that there's a missing plug beside the stove, and that's what it was. So they went in, they fixed it. So anything can be fixed. It's just that you want to have that home inspection for peace of mind that you know that everything big. When you're buying a resale property, so not a brand new property, you want a termite or a WDO, it's called. It stands for wood destroying organisms. They're going to look, if the house is above grade, has a crawl space underneath, they're going to make sure that there's no fungus underneath there. They're going to make sure that there aren't any trails of termites around the property. They're going to make sure that anything that can eat wood, because our houses are all wood frame here. So they're going to make sure that nothing's going to eat that wood to ruin it. So that cost is anywhere between $150 and $250, depending on who we go with. A survey, brand new property, you're going to get a survey that's included with it. A resale, sometimes the seller has a survey, but not always. So the way the contract is written, it's usually on the buyer to purchase a survey, and that's anywhere between $500 and $1,000. And honestly, that depends on what kind of property it is. So if it is a lot and block, which our subdivisions are, that's the correct price range. But if it is a meets and bounds, a lot of land, farmland or something like that, it could be way more than $1,000. I've seen them up to $10,000. So it just depends, again, on how much land. And the reason for that is the extent of work that the surveyor has to do to get that survey for you. Another out-of-pocket cost is an appraisal. The appraisal is the lender requires it. The lender is with all the risk money-wise, putting up the mortgage for the property. And so the appraiser is going to go through and make sure that that is a good investment for the mortgage, that you're not overpaying for the property. If the property has a septic system, I highly recommend that we get it pumped and inspected at the same time. Most septic tanks around here need to be pumped every 5 or so years, depending on how many people are living in the home, how many showers everybody's taken, how many loads of laundry is being done. So septic is about $385. A pool inspection, most home inspectors can do a pool inspection too. You just want to make sure that it's good to go. And then last is a down payment. So if you're VA, Kevin will go over all of this with you, but VA, it's 0% down. You can put something down if you want to with VA, but you don't have to. It's 0%. USDA, which is the rural areas of our community, used to be right at 9 Mile. Now it's pushed even further, and it keeps on getting pushed out as the population is moving further and further north. So we actually have to look on a special website to make sure that that property is within the USDA, but that's 0% down. FHA is another federally backed mortgage, and that one is a minimum of 3.5% down. And then conventional, it just depends on credit score. The least amount is 3%, and there is no max. You can put as much down with a conventional loan as you want. Other additional costs are going to be your title insurance, your loan origination fees, and your homeowner's insurance. And all of those are paid at the title company. So the day of closing, not ahead of time. Closing day, that's the day to celebrate. That you have to bring your license. The title company needs a copy of your license. They're going to double check everything on your disclosure. So there's 2 different disclosures that we have in Florida. One is from the lender, and it's called your CD, your closing disclosure. And then there's an ALTA statement that the title company does. So the title company and the lender is going to make sure that all the numbers that are on those documents match up. They're just slightly off the way that the numbers are presented, but the bottom line is always going to be the same. Before closing, any monies that need to be transferred, your down payment, that kind of thing, that needs to be done ahead of time. So it's usually the day before closing or right before. And then you get the keys and the garage door openers and all the good things so that you can start moving in right away. And you do need to set up your utilities ahead of time. So that is the whole buying process for buying a home. I know that's a lot of information, And so that's why you have people like me and other realtors in the area that we're here to answer any questions that you may have.
My name is Kevin Buchanan. I'm a mortgage broker with Roseth Mortgage. Background about me, I just told you guys a little bit. I spent 20 plus years in the Navy, retired in August 2023. I was an air traffic control officer. That's where I retired at NAS Pensacola. I did that for the last 3.5 years of my career. Enjoyed my time in service, but I was equally as happy to retire. Did a little bit of foray into insurance adjusting, and then got licensed to do this. Met Miss Terry, and I've absolutely loved getting my feet in this and actually being able to help people and give back and educate. That's really a big part of what I enjoy doing, is trying to not just make a dollar off of it, but essentially to say, hey, let's make sure that you know what you're buying and you know what you're paying for, and that you're getting in something that's going to be good for you long term, which is one of the things I really love about the VA home buying loan system anyway. So without further ado, let's hop in. Anybody, first, before I go there, anyone have any prior service ties, family members, or anything like that? Well, thank you for your family service. Sure. So what is a VA loan? We're just going to start off some generic facts first. So it began back in 1944, aimed at essentially readjusting the country from a wartime environment to a straight peacetime economy. And there was obviously, after the war ended, there was a big recession because the military industrial complex really kicked off back in the 1940s to help us win that war period. But the VA loan specifically provides housing and assistance for vets and their families, and has made the dream of homeownership become a reality for over 25 million veterans since its inception. Here's some common misconceptions. First of all, before I get into these, what are some misconceptions you all, this is a big realtor population right here. So tell me, when you hear VA loan, what's your biggest red flag that goes off in your mind? What do you think about it?
I know that some sellers think that a VA appraiser is going to be harder to work with than a regular appraiser. So they hear VA and get nervous.
Sure.
But part of my job is to educate them that VA is one of the best loans out there. It is government backed. Sure. So it's very secure.
Well, and I'm really glad that you brought that up, Ms. Terry. I actually left that one off here specifically for that reason. I was hoping someone would bring it up, because the VA loan is the only loan out there that has 3 methods to litigate. Well, not necessarily litigate, it's not going to court, but as far as between the buyer and the VA, to litigate what the appraisal value is. So first thing, so timeline, here's the current timelines, is once the Florida appraiser takes that case, they have 7 business days from the day it's assigned from them to complete and upload that report. That's it. The appraisal fee is roughly $650, but like Ms. Terry said, if it's a larger property, has a bunch of outbuildings, and it could be up to $800. If there's a reinspect required, it's a $150 reinspect fee for that appraiser to come back out to the property. So let's say we'll get into that real quick about a VA appraisal coming back low. That's what a lot of people. So back in the 90s, and we'll just kind of go back and give you a little bit of history here, because I kind of like history and knowing how stuff came about. So anybody heard of the Tidewater process for VA appraisal? So Tidewater started back in Virginia in the 90s, and that's because a lot of veteran buyers were getting hosed over on the system. They weren't being able to use the loan system because of the appraisals coming back low, and that kind of created a bad taste in the mouth, if you could say that, for a lot of realtors and a lot of sellers, and even military members in general, because they hear it from people that have bought, especially in the civilian community, like, oh, you don't want to use your VA loan because the appraiser is going to be tough and no one wants to buy it. But like Ms. Terry said, the appraiser is literally sitting there basically doing the exact same job that a home inspector is going to do. They're going to come out, look at your 4 systems and such. They're going to walk around the property and make sure it's not in a sinkhole or anything like that. And then they're going to issue their good faith estimate on appraiser. So, and the first step that you know that something's going to go wrong is if the appraiser knows it's going to come in below the asking price, they're going to immediately submit a Tidewater notification out, which at that point, then your realtor, the buyer's realtor, can actually provide comparable sales and such from the local area to support the sales price that you're going, and then the appraiser has to take those into consideration and do a reconsideration of value. So that's step one. If that winds up not working out, then you can appeal it to the regional loan center and get them to step in. And if you still get nowhere, you can ultimately appeal this directly to the Department of the VA for them to either say yes or no on it. Now, of course, the longer, the more you do this stuff, the longer you keep pushing closing dates to the right and stuff like that. So as, I say that it's the only loan program out there with 3 ways to potentially get that appraisal value change, but it doesn't change the fact that it is taking time, right? So that's just something to be aware of for it. But thank you so much for bringing that up, Ms. Terry. Like I said, I thought about putting it on there, but I'm like, I hope this is going to spark a discussion. So here's a lot of things that you're going to hear from. I find, honestly, that active duty military members know absolutely the least about the VA home loan program because I was one for 20 plus years. No one teaches us about this. No one. The VA doesn't come in and provide the training unless you're actually forward leaning and you go out and do it yourself, or buy your first couple of houses. You don't know. I wound up buying 5 homes while I was in the military and selling them, and so I really got interested into how it worked and everything, and which kind of helped me want to get into the lending side of this after I retired. But this is what you see a lot. You'll say, oh, well, I used my VA eligibility once, so I didn't think I could use it again. Like Ms. Terry said, I thought it might be harder to qualify for a VA loan. Some say, well, I was on active duty, but I got out after 4 years. Well, good news about that is if you got out, if you did 4 years, you're good to go. Essentially, if you do more than 2 years, you're good. Now, there are some instances as well, like let's say you go to boot camp. As long as you make 90 days on active duty, then you're eligible for a COE if you get discharged for like medical reasons and things like that. There's a whole list, and I could put all that on here. I'm huge on numbers and everything, so I didn't do it. There's going to be a lot of meat on here, and I'm just going to kind of breeze through the high points for y'all. It is only for veterans and still on active duty. I've heard that before. I have VA entitlement, so I automatically qualify for a VA loan. Not necessarily true, because even though it's a VA loan, and yes, you have that benefit where the VA loan is going to guarantee you a certain amount, you still have to qualify under basic lending standards. Here's the other good one. People, I can tell you that 99% of veterans out there have no idea what a COE looks like. They have no idea how to interpret the loan, what it's saying at all. So when you look at a COE, I thought about actually putting a COE in here, but I ran out of time. So when you get the COE, you're going to see a couple things when it comes to your basic level of entitlement, meaning that if that veteran has never used a VA loan before, or they had a VA loan property before and they resold it and had their full entitlement restored, then what you're going to see is their basic entitlement use will be 0, and they'll have $36,000 of guarantee. So that's your like the first amount, your basic entitlement. Then, so people see that 36,000, like, well, I can't afford a house with 36,000, so what's the VA good for, right? So that's where your secondary entitlement comes in, another 144,000 on top of that. But I'm going to blow your mind real quick, because we're talking about these numbers for a COE and what you can get for it. Fact of the matter is, as long as your credit is good enough, there is no limit for your first time use on the VA loan. Absolutely none. Provided, of course, like I said, your income has to match what you're going to buy. The VA is not going to let you get $1 million house and you make $100,000 a year. It's probably just not going to happen. But that's how that works. So as far as what the VA loan guarantees, they guarantee 25% of whatever that loan value is. So when you start doing your math on how much entitlement you get, that's how you do it. So 25% of whatever that value is, that's where you're going to. Now, where that entitlement really starts coming into play is if this is your subsequent use, or you already have one VA loan in action, and now you have X amount of dollars in remaining entitlement. That's where your county loan limit is going to come into play, because if the house is more expensive than whatever the VA county loan limit is, then now the VA is only going to guarantee up to that amount based on your entitlement. So any amount that is over the sales price wise, over what the VA is going to guarantee, then that's what's called a cash gap, and then we got to figure out how to cover that with from the buyer. So let's see, more misconceptions. Some of these we've already talked about before. They believe they might cost them more money because of VA rules. They assume their fees are automatically moved to the seller, but in reality, most of the time a buyer can cover most of, if not all, the fees being charged. Some people believe that the VA loans, because they're 100% financing, the buyer might be a risky buyer. But in reality, the VA loan program has the lowest or second lowest default rate of any program in the country. And you might ask yourself why. Well, a lot of us have security clearances that you have to maintain. You miss one payment, then you're sitting in your commanding officer's office explaining to him why now your security clearance is being revoked until you get it fixed. No one likes that, and the military doesn't play. If you start owing money, they literally will take you down to the HR office and make an allotment that goes out of your check straight to wherever you're going. So it's, and especially in the higher tech jobs that require the top secret, they don't play around with it. Others believe that it takes longer to close a VA loan. In actuality, an experienced loan originator is going to get it done pretty much as fast as anything else. The biggest step, if you're working with a lender, is make sure as soon as they submit that offer and they have that loan ready to go in underwriting, get on WebLGY and order the appraisal that day, because that's the biggest step, is ordering the appraisal and getting it out to the whatever the county appraiser is. The sooner you get that done, the sooner that clock starts for that for the appraiser to be able to have those 7 days to get it. Now, I say 7 days. That's here in Florida. You know, everywhere across the country, there's different timelines. So, and if the market ramps up and gets super busy, then it could get the appraiser could file for an extension. So keep that in mind as well. Okay, we just talked about the appraisal stuff a little bit, about how they come in low and everything. So again, a VA appraisal is pretty much very similar to how the FHA appraisal is going to work. If a VA appraiser comes out and says, hey, this is a conditional repair on this property, meaning I'm not going to certify that my appraisal unless the repairs are made, and at which point, like Ms. Terry said, you got to have a licensed contractor come out to inspect, repair, whatever the issue was. And then once the appraiser comes back out and re-inspects, again, that's a $150 fee if they had to do that, then they'll certify the appraisal. Here's some important features for the VA buyer. So the property that they're looking to finance with a VA loan has to be your own personal property. You can't, we're not using a VA loan to finance investment properties. Like I said, there's no maximum guarantee. This is up to 25% of the FHFA max conforming limit. Previous understory entitlement, which is just what we talked about a few minutes ago about how much the VA actually guarantees per loan that they send it. Essentially, and we'll get into the funding fee here in just a minute, but the VA funding fee essentially acts like the mortgage insurance premium for the VA home loan program. There are fixed or adjustable rate options out there, and they're always fully amortizable, so there's no interest-only options available on a VA loan program. Flexible credit standards. Now, what do you mean by that? So flexible credit standards is, every other loan program out there is going to go based off your front-end housing ratio and then your back-end debt-to-income ratio that factors in your principal, interest, taxes, insurance, and whatever liabilities that you have on your 1003, your loan application, that are any kind of debt that you have that you signed a promissory note to repay, or revolving debt like credit cards. So keep that in mind. The VA loan does not have mortgage insurance premiums. However, there is the VA funding fee, which essentially is your mortgage insurance. But unlike the FHA funding fee, where you pay an upfront portion and then a monthly premium for it, the VA funding fee can be financed onto the back end of the loan. So, and that's how you get to your 100% loan to value, where, no down payment, and then you're actually, but it's kind of like everything else, right? You can make a down payment on it, and if you make a down payment, the funding fee actually goes down based on how much your loan to value is. So if a buyer has the cash to do it, it could potentially help them, especially in times like right now when the interest rates aren't the best. No prepayment penalties, meaning, if you wind up having a windfall and you want to pay your mortgage off, go for it. VA does not care. Biggest thing to do, if a seller pays off their property, they do have to file for the VA to reinstore their full entitlement. It doesn't happen automatically. So now, if there's doing, like I've done this several times, where I'm transferring from Virginia down here to Pensacola, and I'm buying a house and selling a house. So if you're doing it, essentially you're going to do a concurrent close, where you close that first one on the sale, and then 10-15 minutes later, close on a new one, good to go. Also, the VA offers assistance to borrowers in default. So you're going to get reached out to the VA pretty much immediately after you get it. They're going to send you a package of stuff that says, hey, here's your rights and entitlements for the VA loan program. You can always find that on VA's va.gov as well. But they're essentially telling you, like, hey, we don't want you to lose your house. This is it. We don't want you to lose your house, and we don't want you to suffer the negative impacts if you default on your loan. So who is eligible? Applicant must be an eligible veteran who has available entitlement. The loan must be for an eligible purpose, which we'll get to here in a moment. Must occupy the property as a primary resident, and the veteran must be a satisfactory credit risk. The income of the borrowers must be shown to be stable and sufficient to meet the mortgage payments and cover the cost of owning a home while taking care of their other family obligations. You see in parentheses there, residual income. So that is how the VA loan is different by the FHA loan and conventional USDA, where they go off that debt to income ratio. That residual income is really going to be the backbreaker or the deal maker when it comes to the VA loan, because there's tier levels based on how many people that are in the family. Like if you're single, that residual income is lower, but the more dependents you have, the higher those residual income limits get. Still, when I say flexible, is very flexible. For a family of 4, and don't quote me because I don't have it in front of me, I think it's roughly about $1,200 in residual income that the buyer has to have left over to cover those expenses. The VA loan program, I don't think I put this in here either, but you can get finance on a VA loan down to 580 on their mid FICO score. So that's excellent, excellent acceptability. So how do you determine your eligibility? So the veteran can go to va.gov and pull their own certificate of eligibility if they have access and an account and all that stuff. Now, in reality, the best way to go ahead and do this is if they have a lender, have the lender pull it, because the no lender and really the VA is not going to accept a buyer submitted COE just because there's potential for fraud with that. So I have a system that I log into and I input the buyer's birthday, social security number. Within 5 minutes, I have a COE. If there's a problem, that's when we backfill with the client to get service dates and all that stuff, and we'll contact a regional loan center and figure out what's wrong with this buyer's stuff. Yep, so we covered that part. Moving on. So what can I use it for? So this is a part that people definitely don't have all the information on. So you can buy or build a home with up to 4 family units, including townhouses, condos, in a VA-approved project. So if you buy those 4 family units, then one must be the buyer's primary residence. So in this build a home, this is one that people really don't know a lot about. So you can there's several lenders out that have VA one-time construction closed loans. I'm actually interested in one right now myself that, again, the minimum FICO is 580 on it. There's a 12-month build period on it where the builder has 11 months to complete the build, and then you have a 1-month period on the back end of that for punch lists, inspections, certificate of occupancy from the county, and all that stuff. Biggest feature of that for the VA home buyers that there are no payments at all required during that construction phase, so they can continue living in their primary residence and do that concurrent close like I just mentioned before to keep money in their pocket. So it's good. Note, the VA does technically allow more than 4 units per the VA lender handbook, but Ginnie Mae does not. So, when there's kind of like uniform, I always equate it to uniform standards when you're in the military. You can always make things more stringent. You just can't make it more lax than the government standards. So that's kind of how you go with that. Another thing that's not really known abundantly throughout the real estate world, and definitely not on the VA buyer side, is that you can buy a manufactured home with the VA loan program. The biggest thing is it has to be permanently affixed to a foundation, meaning concrete slab or crawl space, anything like that. It can't just be on wheels because 1, you're not going to be able to get it insured. 2, they want to make sure it's not going to blow away on you. You can also use it to do energy efficient installs like solar panels, cooling systems, water heaters, insulation, basically any other. Again, I defer always to the VA's website if they're looking for something like, hey, I want to know if I can use my VA loan benefits for this after I'm in my house. Go to the lender's website. It will absolutely tell you. Big thing about solar panels, and I'm sure you all as realtors probably have, you probably every time you go up to a house that has solar panels, right? So I'm actually doing a cash out refi right now for a guy that has solar, and it has a lien on the solar has a lien. Not a deal stopper, especially on a refinance. It's a little bit easier. The loan, so technically, whenever they close and they pay off that first loan for him, that would make that solar loan go into the first lien category. Well, no lender is going to finance a home and be second in line, because if you default, then whoever's first has rights to the proceeds on that. So by doing it this way, you can actually work with the solar company, and that's what I did today for this buyer. Got a subordination agreement from the lien company to put them in second behind the new lender. Not hard. Most of them charge like $150 fee for that though, so you got to pay them. But yeah, if you're selling it, that's tough. You guys already know the beans with that. It's going to be tough to negotiate a new buyer to take over that lien, because not only do they have to qualify for the credit to buy the house, but now if you add in that second lien, that could very well put them on their debt to income ratio outside your margins. So what else can I use it for? So you can refinance an existing home loan. You have a couple different options, right? So interest rate reduction loan is pretty standard, is exactly what it sounds like. So meaning if your interest rates drop by at least 0.25%, then the veteran can refi that loan. There's no appraisal required. It's literally just refi and you're done. Cash out refi, there's two types. So you have type 1 and type 2. A type 1 is where the loan balance is lower than what you're actually refinancing to. And when I say they're exceptionally rare, they're literally just kind of a footnote in the VA lender's handbook. Type 2 is the more popular option, because your new loan amount is obviously going to be higher than the previous loan amount. Biggest thing with that one, and if it's like conventional or FHA and the buyer is now pulling it back into their VA entitlement, you can do that. Biggest thing with a cash out refi is you're going to have to do another appraisal, another home inspection, another WDO inspection. Essentially, anytime you hear VA other than the interest rate reduction refinance, WDO and appraisal is coming in. Unless there's one more, assumable loan. If you're assuming a loan and taking it over right there, there's technically no reappraisal requirement, because the primary lender still holds the lien on that for it if you do it that way. So what can't I use it for? You can't purchase just bare bones land with the intent to prove it later. Like I said, if you're doing a one-time construction close loan and you're doing it with the intent to build your primary home right away, you're good to go. You cannot use it for the purchase or construction of a dwelling for investment purposes. Has to be your primary residence. There can't be more than one business unit available. Non-residential does not repair the residential character of the property, and the property is legally permissible to current zoning or legal non-conforming. Continue, we got a little bit more. The purchase of more than one separate residential or lot, unless the veteran will occupy one lot, and the evidence is there that the units are unavailable separately. The residential units have a common owner. Units have been treated as one in the past or assessed as one unit. You also cannot use it to refinance property on which there is not currently an existing lien. So if the property is paid off and the buyer's wanting to do a cash out refi to pull equity out of the house, you can't use a VA loan for that. So if they want to do a cash out refi, pay their loan down to $1 and then do it. That's my advice. Okay, can I rent? This is big too. This is something that is definitely not understood across active duty at all. Can I rent out my home when I PCS? Absolutely you can. So the law says that the veteran must intend to occupy at time of purchase. Technically, the veteran can move out 3 days, 8 months, or 12 years later and turn the residence into a rental. And the reason for that being is, there's a lot of last minute changes. Like I was actually en route to a duty station one time and got called and said, hey, those orders got canceled. Stay in the hotel and we're going to tell you where your family's going next. So my household goods were in shipment and everything else, and we got turned around. We were going to Washington State and wound up going to Norfolk instead. So fun times. So essentially, like I said, if you'd already signed on a contract and you're financially obligated to that house, now they're like, well, the VA is not going to just let you out of that loan. So what they're doing is saying, hey, well, we can't do that, but you can rent it out. Problem with that is now, it could have eaten up most, if not all, of your eligibility. So that is That's the only downside for it. You're free to do whatever you would like after you purchase property as your primary residence. Like I said, you just have to have the intent to occupy when you close. A lender is going to do a due diligence on it, essentially say, hey, a lot of times they're going to get a copy of your PCS orders. If you're currently living in Virginia and you're looking to buy a house in Pensacola, you have to submit a copy of your PCS orders along with it for the VA to be able to verify that. Anyone that is interested in this PowerPoint at all, feel free to give me a card or your email address, and I will forward it to you. I'm happy to pass this out and get as much knowledge out there in the community as we can. So you want to buy again at your next duty station, even if you have one. Yeah, absolutely you can, like I said, but it comes to how much money you've got left in your eligibility. Which can be a deal breaker, right? So if I'm technically only able to buy another home for $300,000, but the cheapest I can get it for my family is like $450,000. Now that extra $150K, I've got to figure out how to pay that, and that, not a lot of us on active duty have that kind of money rolling around. So if I mentioned this a little bit ago, if you sell that previous home, make sure you get your full benefit entitlement restored. It does not happen automatically. You have to request it. Now, if you're doing it in a real estate transaction, most of the time it's going to happen for you. But so here's a big issue for it too. To kind of like the math gets wonky. So I'm doing this for you real quick. If you're retaining that rental, that website up there that's on there, if you can read that, definitely write it down. Or like I said, I will be happy to send this presentation to whoever would like it, because this makes it super, super simple. You just go in and put in the request and information, and it literally tells you how much you have left and what your max loan can be. It's based off and it includes your current zip code for where you're going to buy as well. So it factors in the county loan limit for wherever you're looking to buy. But if you like funky math, take a look at this nonsense up here. So when you're purchasing partial entitlement, you're going to go off your appraised value at purchase price or higher, and it's over the county loan limit. So available entitlement equals 25% times whatever the county loan limit. So I think Santa Rosa is like 524 or something like that, if I remember correctly. So you do 25% times that, subtract that from any previously used entitlement. That's how much entitlement you have remaining. But we ain't finished yet. So then you're going to multiply that remaining entitlement times 4, and that is your maximum loan with no down payment required. Like I said, you can do it that way or go to the website. I go to the website because I grew up in Alabama. All right. So here's just a quick example with it spelled out for you. So say I'm purchasing a house for $600K and I've used $50,000 of previous entitlement. And now I'm buying in a county where that loan limit is $726,200. So that is how the math works out right there. And I'll give you a minute to take a gander at it.
Just showing that you have to have.
Yeah, essentially that's right. Yep. So what are some costs with a VA loan? VA funding fee, if this is your first time ever using the VA loan, your initial use is 2.15% of the loan. So 500,000, do the math on that. It can get pretty pricey pretty quick. Subsequent use, this is what really knocks people over the head here. It's like, man, I used it once and now I'm using it again. Now I've got to pay a 3.3% user fee on top of it, which I had to do on this last home that I'm in. And it was, yeah, it hurts your feelings a little bit. But and then I retired, and now if I ever want to do a refi on my house, because I'm receiving VA disability, then it's 0%. Even if your buyer's only receiving 10% disability, they're entitled to not have to pay that funding fee. Appraisal fee, that can be, again, these are rough estimates. The one I just did here last week is $650. Basically, the bigger the home or the bigger the property is, it can go up. Home inspections, I put just a basic range there, and that's depending on your level of inspection. Do you want just wind mitigation 4-point or full workup for wind, like the in-depth home inspection where they go on, they give you the pictures of everything, and then like pool inspections, outbuilding inspections, it can get pretty pricey. Then, like Ms. Terry said, the termite WDO inspection is a required inspection every time you do a VA loan, unless it's like the VA IRL or an assumable. Closing costs can be between 3 to 5% of the loan, depending on factors like that amount of that funding fee, seller concessions and credit, which we'll get into here in just a minute, title fees, property taxes. So you'll see that in parentheses there. Like if you know someone that has 100% permanent and total disability, as confirmed by the Veterans Administration, in the state of Florida, you do not have to pay any property taxes other than, I think, the fire county tax. It depends on what county you're into. I think for mine, I pay about $214 a year in property taxes for my house. So that saved me about $500 a month after I retired. So seller concessions. They include, but are not limited to, payment of the funding fee, prepayment of taxes, insurance, gifts like refrigerator, washer, dryer, TVs, payment of extra points to do permanent interest rate buy downs, provision of escrow funds to provide temporary rate buy downs. They do not include, and this is a big part, they do not include payment of the buyer's closing costs or payment of discount points as appropriate to the market price up to 2%. I talk with my hands a lot if y'all can't tell. Let's see. So seller concessions are not credits per the VA's definition, and this is where anybody know what that magic number is, and it's kind of down there at the bottom. So anybody know what the magic number is for VA is 6% for FHA, but it's 4% for VA. But here's where the kicker is. A seller concession is a seller paying for things they wouldn't normally pay for on the buyer's behalf. So if the seller is giving away like a Ferrari as a concession, then the seller is paying for the buyer's allowed fees like appraisals or points, and that's not a concession. That's more of a credit that doesn't fall into that 4% rate. So in reality, seller credit, which is what is on the purchase contract, can be larger than 4%. Honestly, you can get up to the point where you'll have 6, 7, or even 8% before the concession rules become an issue based on the selling price of the house. And here's an example. I love examples. So again, credits have no limit and they don't count against the seller concessions of the 4%, which is a rule for that. So in this example I'm providing up here, the total credit provided by the seller or the seller credit is 6% of the purchase price. Yet the seller concessions are only 2 3/4 of the purchase price, making it perfectly acceptable for the VA. So we'll just do easy math here. $100,000 purchase price, and the seller is given $6,000 towards that seller credit. So again, easy 6% math right there. Here's our costs covered by the seller's credit: lender fees of $1,000, appraisal $450, escrow fees $1,250, title $450, and recording fees $100. Again, those are just examples here, not true to cost. Costs that are true concessions per the VA definition and fall under that 4% rule are your daily interest, your taxes, insurance, and reserves. Okay. Now, if you add all those up, that's going to get you to $2,750, which on the basic $100,000 loan is your 2.75%. So you actually still have 1.25% in room for your actual concessions. What I will say, there are allowable costs and non-allowable costs in the VA Lender's Handbook. It's a pretty long list. I didn't want to take up all y'all's time and put it here today, and I know I'm already running late, so I'll keep moving. So in essence, there's a whole lot more stuff that you can and can't pay for, but these are pretty good basics here. Important thing to know is, like, a lender that's not used to doing a VA loan, they'll just look at your max seller credit and tell you, no, you can't do more than 4%, and then you're taking money out of the veteran's pocket at that point. Call me. And that's really all I got right there. That's the back end of my business card, which I have some up here. The one here on the left-hand side of the screen will schedule a consultation, and the one on the right will schedule we'll take you right to an application page.